why isn't anybody talking about this? So this thing I read, it got me thinking about our country. And it said societies always collapse the same, slowly at first, then all at once. What do you guys think? Do you feel like that's happening to the United States? Yeah, we've all probably heard of the latest Fed rate hike and what it's going to be doing to people's debts and all, but really what I don't hear mainstream media talking about is the impact of this interest rate hike on the US deficit and really our debt crisis as a whole. I mean, household debt is the highest that it's been in recent history. Check this out.
Thanks, Judy. Yeah, the New York Fed in its fourth quarter household debt and credit report reporting that debt surged by $394 billion in the fourth quarter. That is the largest increase in 2 decades. Breaking it down, mortgages up a strong $254 billion. Credit cards up $61 billion, the largest quarterly increase in the history of the survey going back to 1999. Auto loans up and student loans as well. Now, as far as delinquencies, they did tick up for credit cards, auto loans, and mortgages, but the rate or the level remains at or below the pre-pandemic level. Trouble is the transition into them. There have been some worrying increases to the transition of delinquency rates. So a blog by the New York Fed, the accompany this report, says credit card borrowers are missing their payments and transitioning to 90-plus day delinquency at a rate higher than they had before the pandemic.
Now, I know we just went through this with the recent U.S. deficit showdown in Congress, but with the Fed's latest rate hike, America may need to start caring about the deficit again. The United States is facing a fiscal deficit that we've only ever seen in times of deep crisis in the country. And experts predict that it's only going to get wider if Congress stops paying attention. Major warning from the Congressional Budget Office. This could result in higher interest rates, inflation, and reduced private investment and growth in the coming decades. This fiscal year, the deficit is projected to reach 5.8% of GDP, a level seen in only 7 years since 1962, all of which were marked by significant events like recessions, financial crises, and or the pandemic. 1983, you had the aftermath of severe recession, 2009 through 2012, the global financial crisis, and of course 2020 through 2021, the pandemic. Seriously, it's like the names of a bad movie trilogy. You know what I mean? Congress is hoping to narrow the deficit temporarily with their recent negotiations, but after that, this whole thing could blow up and surge in the 2030s and 2040s. Plus, the projections that they're giving us, they're all based on steady economic growth, and they don't account for any kind of unexpected shocks that could ultimately disrupt the financial outlook. In the late 2010s, low interest rates led to complacency about deficits. Then, the pandemic happened, and nearly $5 trillion of emergency spending was added to the debt. You know how all these big companies and government officials talk about having an emergency fund, right? Well, our country doesn't seem to have that, so when a crisis does happen, we end up getting further into debt. And about those interest rates, net interest costs on the U.S. government, they're on track to reach 2.5% of GDP in 2023, and it's only going to be rising steadily from there. From 2053, net interest could be pretty painfully sitting at 6.7% of GDP. Now, this is money taken away from other national priorities like Social Security and EBT, SNAP cards, etc. And you know what? Some experts are arguing that reducing the deficit could be an even more effective way to curb inflation rather than what the Fed is doing, which, by the way, is raising the interest rates to kingdom come. Now, get this, guys. The gross national debt just exceeded $32 trillion for the first time. And the big deal about this is that the $32 trillion mark arrived 9 years sooner than the pre-pandemic forecast had projected. This is not a good sign. I mean, we're really starting to feel the trillions of dollars of emergency spending for C-19 combined with how slow the economy has been recovering from it. Y'all know what I mean? Are you seeing what's happening here? The recent bipartisan agreement suspending the debt limit for 2 years, it cuts federal spending by $1.5 trillion over a decade. Now, according to the Congressional Budget Office, by essentially freezing some of the funding that had been projected to increase next year and then limiting the spending to 1% growth in 2025. But really, it was all just kicking the can down the road since our national debt is on track to top $50 trillion by the end of the decade, even after these newly passed spending cuts are taken into account. Plus, those spending cuts proposed by lawmakers didn't really cover the shortfalls of our social safety net programs like Social Security and Medicare. They're still headed for depletion by 2034 at the rate that we're going. And the U.S. population's not getting any younger. With large amounts of sovereign debt, there are only two choices within the current thinking, and they're keeping the money supply constant, which would cause crowding out for available money between the government and private sector, and higher interest rates, or the Fed giving in and printing more money to lower interest rates. But ultimately causing consumer and asset inflation. So it's between higher interest rates and deflation or inflation, as you said. But there are some out-of-the-box solutions. Now, one is the new technology that's coming out this decade for free energy. Tech could be the saving grace, like it was in the past with computers and telecommunications. Now, another solution for the government to allow the price of gold to rise to about $50,000 an ounce and then use the gold to pay off the debt. Sort of like a family in financial trouble using their assets to pay their liabilities. I mean, just look at Bitcoin. Now, if those prices start going down or way up, that could be the canary in the coal mine for our economy. But seriously, guys, like, why isn't anybody on mainstream media talking about this stuff? The federal deficit nearly tripled in 9 months of the fiscal year. The Treasury Department confirmed this and even said that the budget gap for October through June, it was nearly $1.4 trillion. This is a 170% increase from the same period a year earlier. Now, just to clarify, guys, the federal government, they operate under a fiscal year that begins October 1st. And so that's why they call it a fiscal year. Go figure, right? And like I said, the shortfall is adding to an already large federal debt estimated at more than $32 trillion. Plus, you got financing that debt. It's getting increasingly more expensive because of rising interest rates. Interest payments over the last 9 months reached $652 billion. 25% more than during the same period a year ago. The deficit ballooned both because of the sharp increase in government spending and a significant drop in tax revenues. The S&P 500 stock index fell nearly 20% in 2022, so that means that investors realized fewer capital gains last year and they paid less in capital gains taxes this year. Overall, tax revenues between October and June, they were 11% lower than the same period a year ago. Now, at the same time, government spending jumped 10%. Spending on major healthcare programs such as Medicare and Medicaid rose sharply. Social Security payouts, they jumped 11%, thanks in part to that 8.7% cost of living adjustment, the COLA for retirees and other recipients, the largest increase in 4 decades. Oh, and let's not forget about the bailouts. The government has also paid $52 billion so far just to cover deposits at 3 regional banks that failed earlier this spring. So yeah, it's supposed to come from the FDIC's Deposit Insurance Fund and a special assessment on other big banks, but we all know how this is really going to come back to bite us in the rear end at the end, right? And as experts pointed out, we are projected to spend more on interest payments in the next decade than we will the entire defense budget. It's definitely hard to imagine that that will be something that's sustainable for the American people. I mean, am I right? They keep telling us to pay down our debt, but the federal government doesn't seem to be doing that. By the way, if you own a home, make sure your home is protected. Get your free home warranty quote. There is a link in the description down below of this video. I mean, we're about to reach the $1 trillion mark in our interest payments as a country, guys. The current amount is approximately $970 billion, which is an increase of $41 billion in just the second quarter. That's a pretty significant threshold if you ask me. $1 trillion mark in interest payments? I mean, that's bigger than some countries' entire GDP and their entire economy. Now, if our interest payments were a country, it would be in the top 20 GDPs along with countries like Indonesia, Turkey, Netherlands, Saudi Arabia, and even Switzerland. So yeah, it's big. Plus, our tax receipts aren't really catching up with the sovereign debt crisis that we seem to be spiraling down. So the United States has to rely very heavily on unsustainable funding strategies, continuously issuing more debt. Now, this vicious cycle leads to a situation where interest payments, they become increasingly funded by revenues generated from additional debt issuance, just making this whole financial predicament even worse. Now, just to compare, on this very day in 1980, the United States national debt was less than $1 trillion. That was our whole debt, guys. The entire obligation of the United States government was only $1 trillion. But now our interest expenses alone are reaching almost $1 trillion. Now, if the Federal Reserve slows or stops interest rates from rising this year, like, what a lot of economists are expecting, I think that the bigger problem is that the nation's borrowing costs are only going to continue to increase. And that is because the existing debt matures. The government issues new debt with the higher prevailing interest rates, and basically we screw ourselves. Some people's theory, they want the interest rates as high as possible when that 2-year debt needs to be refinanced. Kind of like a purposeful attack by the Fed on the economy to allow for a takeover. Keeping interest rates at nothing, cranking out short-term loans, then raising the rate when the refinance time comes definitely sounds like a disaster to say the least. But what do you guys think? The higher interest rates could also increase the net interest costs on the national debt to about $9 trillion over the next decade. That's up from the record $8.1 trillion that the CBO projected in May of 2022 and $5.4 trillion that it projected in July 2021. By 2032, the interest cost will triple to more than $3 billion per day and to at least $9,400 per household. Now, they're on track to become the largest federal budget item. This would be even surpassing Social Security and Medicare by the middle of the century. And just when our interest payments keep taking a bigger piece of the US pie, that is only going to make it that much more difficult for the US government to fund all of the things that are so important to society. Do you see where this is going? By the way, if you guys made it this far in the video, please consider dropping a like for the video and subscribe to the channel for more content like this. I really appreciate hanging out with you guys, and I'm gonna see you guys on the next one.